Investors Talk. My name is Lindsay from Securities Research. Today, we are privileged to have Ms. Elina Fung, Investment Director Equities from HSBC Global Asset Management, to share with us some of her near-term prospects on Asia ex-Japan markets, in particular on the small to mid-cap space. Ms. Elina Fung is an Associate Director in the Asia ex-Japan Equity team and has been working in the industry since 1995. Prior to joining HSBC in 2007, Ms. Elina worked as Financial Controller and Company Secretary at North Star Founders Group Limited, a main board listed in China auto parts manufacturer. Previously, Elina worked in equity research for 6 years. She holds a Bachelor of Business Administration from the Chinese University of Hong Kong. She is a member, as well as a fellow member of the American Institute of Certified Public Accountants. And she is also a fellow member of the Hong Kong Institute of Certified Public Accountants. Thank you, Ms. Elina, for taking time to attend this interview with us. With advanced economies losing steam, US not recovering as fast as expected, Europe outlook dim, Abenomics hype waning, all heads turn back to Asia ex-Japan. Would you agree that Asia ex-Japan region is a more attractive market to invest in near term?
Well, I generally agree to this statement. Well, I would like to talk about the large cap and the small caps. I think the large cap index has been pretty much affected, by the macro situation of the past few years, especially the North Asian markets. The ASEAN markets were doing quite well until second half of last year, when there was severe for QE tapering that actually hit the ASEAN markets as well. So at current valuation, I would say that the Asia ex-Japan market is getting quite interesting. I think it's trading at 1 standard deviation below the historical average, and it is also much cheaper than the developed markets valuation. So from the valuation perspective, I would say that it is pretty attractive. And also from the economic situation, now that we see US gaining a stronger foothold in terms of economic recovery, so we don't worry about any potential shock from the US on the Asian economy. And if you look at the individual Asian economies, domestically, a lot of improvement that we have seen already. Indonesia, we already seen a president's election. India as well. China, we're also finally seeing, the PMI getting above 50 for the first time in many quarters. So I think Asian economies as a whole is actually recovering, or at least, we have seen the trough already. So based on this kind of valuation and the outlook that we have in terms of Asian economies, I think we are turning more positive. But if you want to talk about small cap in particular, small cap index has actually rallied over the past 2 years. So a lot of questions were asked on as to whether we still see value in Asian small caps. My answer is yes, because from time to time we do see opportunities in different countries. For example, I want to highlight 4 countries now, i.e. Hong Kong, China, Indonesia, and India. If you look at the price to book for small cap markets for these 4 countries, you can see that they're still trading below historical average, despite the rally. So we still see opportunities in the small cap market as well. But of course, it is important for us to be able to pick the right stock, with the right profitability and a reasonable valuation, which is what we are doing on a daily basis.
Could you also share with us a near-term view on the Asia ex-Japan markets, in particular to the 4 countries that you had mentioned before?
All right. As I mentioned, the election is done for Indonesia and India. So we are actually more positive towards the 2 countries. But in terms of valuation, Indonesia seems to be more expensive than India. And also, as far as small cap is concerned, we saw some profit taking for some Indian small caps. So we think we are more, that some of the Indian small caps are getting more attractive in terms of valuation. So we are looking into more details into the Indian small caps. On the other hand, on Hong Kong, China small caps have always been below, trading at a discount as compared to the Asian counterparts. So we continue to see values there. And in the near term, we also see increasing foreign interest over the Hong Kong, China market. Because of the expectation for the implementation of the Hong Kong Shanghai Connect That could happen in October or before end of this year. We don't have a fixed timeline yet, but it's likely to happen towards the end of this year. So there are lots of interest regarding Hong Kong, China at this stage.
Any markets which you think look overheated? Any markets which currently present a good entry point, or any countries that you are optimistic on?
We see opportunities in Hong Kong, China. We see opportunities in Indonesia and in India. But I actually want to highlight a few sectors that we are actually more interested in, rather than just talking about the markets, right? Within the small cap universe, we're actually quite interested in a few themes. One is the ASEAN oil and gas theme. So what happened is, if you look at some countries like Malaysia and Indonesia, in the next 5 years, they are going to spend a lot more money in oil and gas capex compared to previous 5 years. In Malaysia, we are projecting a 70% increase in capex in the next 5 years. For Indonesia, we're talking about close to 170% increase. Yeah. So that actually creates tremendous opportunities for the domestic oil service companies there. So this is one theme. The other theme is a lot of people were quite bearish about textile sector because they thought that textile sector is a dead sector for over the past decade, and they don't see any chances of revival for the sector. We sort of hold a contrarian view, because if you look at the number of textile companies, or particularly Chinese textile companies, 1/3 of the companies have actually exited the industry since 2008. So there is a huge market consolidation going on, but the stock market was not aware of it. Yeah. So these survivors actually gain market shares, and they actually enjoy top-line growth, decent top-line growth as U.S. economy recovers. And on the other hand, they also actively cut costs by shifting their facilities out of China into ASEAN countries, namely Indonesia, Malaysia, Cambodia, Vietnam, where the labor costs were much lower. So the blended unit labor cost was much lower, which helps them to expand the margins. So going forward, I think although we don't see a very strong rebound in U.S. apparel, you're talking about maybe a low single digit a year, but because of this consolidation going on, we find that there are some selective textile companies which are very, really interesting. Third theme would be about environmental. This is a big theme, across the globe. And in China in particularly, we see opportunities in the water treatment area. One statistic shows that actually 70% of China's water is unfit for human contact. So you see the kind of urgency that the Chinese government need in terms of, cleaning the water in China. So we have some exposure in water treatment names. Same case in India, especially after Modi sworn in as the president. So he actually wants to spend a lot more on cleaning water or improving the hygienic condition in India. Also a similar, well, not a similar situation, but we also see some kind of similar situation in Malaysia, especially in the state of Selangor. You heard news about the water shortage there, and there were huge water leakage there. So there were some opportunities there as well. Regarding alternative sector, you know about what happened to the Beijing air pollution last year. So no doubt Chinese government have to spend a lot of money in boosting alternative energy investment. Same case for India and also in Thailand. So we put within the alternative energy segment, we particularly like solar. So we have quite a bit of investment in solar energy.
Referring to the solar energy industry in China, as you mentioned, there were comments that the industry is suffering from overcapacity. Could you shed some light with us on the issue?
I think for the solar energy, there are different segments within the supply chain. For example, you have the component makers. So a lot of news coverage on how the components price have gone down and affected, the profitability of the component makers. The other segment is the EPC segment, i.e. these contractors actually buy the components from the component maker and assemble them into, either distributed rooftop projects or for solar farm projects. So these guys were not affected by the decline in raw material prices, because they only mark up a certain margin, right, on top of the components. The third one would be those at the end of the supply chain, those solar farm operators or distributor PV, operators. So they are in general being subsidized by the government to make sure that they generate a decent IRR. So it depends on which segment you're talking about. We are more bullish towards the second and the third segment within the supply chain.
Could you also share with us your portfolio strategy?
Well, within HSBC, we actually adopt an investment philosophy whereby we believe that stocks with good profitability, we see their valuation going up in the long run. So it's a simple strategy. Regarding profitability, we're talking about, we use ROE as a benchmark. For valuation, we actually use price to book as a parameter. So we look at the stocks within our universe based on this price to book versus ROE, and we focus a lot on stocks with a reasonable price to book and ROE matrix. So this is a way, that we apply our strategy. And for the small cap fund, we focus a lot on bottom-up stock selection. And one thing that I want to highlight is that this is very important, in particular for small caps, because if you look at the small cap universe, only 20% of the small caps are under active sell-side coverage, meaning 80% of them are not under active sell-side coverage. This creates huge inefficiency in the market. So we like this kind of inefficiency because that creates opportunities for people like us who do fundamental stock pick and stock selection. And because we are also backed by a huge research pool, within HSBC we have over 60 investment professionals, including analysts, who can help us to do research on these areas. And for the small cap fund alone, we have 2 dedicated full-time fund managers. I'm one of them, and Alex is the other one. So with the 2 full-time dedicated fund managers, it actually gives us a lot of bandwidth to discover names that are under-researched and overlooked by the market.
As your investment strategy focuses on the smaller cap universe, which usually has a higher risk beta, thus implying a higher volatility, in this higher risk environment, would you take a more conservative or aggressive approach?
We try not to, because as I mentioned to you earlier, the HSBC philosophy itself allows us to invest in companies. For example, if the company has a similar profitability, we only invest in those with lower valuation. So the strategy itself allows us to be more conservative in the first place. We are not chasing momentum. We are not chasing stocks, that have seen very good, price rally over the past few months, and chase after that. We don't do that. So with this kind of fundamental research support that we have in mind, by right, we should mitigate some of the risk regarding small caps already. But of course, when we pick small caps, we try to identify stocks or companies which meet certain criteria. First of all, they need to have a business model with clear audit trail. Secondly, we are more interested in stocks with positive operating cash flow. And better still if they can pay out dividends. And if they have a decent dividend yield, that would be even better, because that would sort of alleviate some of the market's concern over corporate governance. Thirdly, we also make sure that we invest in companies with a long management track record. So they could be newly IPO, but the management has to be in the industry for quite some time, in order to give us some more comfort. And one very important thing that we do here is that for all the key positions that we hold, we make sure that we have our own earnings models. And we think that is very important, because by having the earnings models, we get hold of the key assumptions and the key swing factors that will affect the company's earnings and ROE. And by having this kind of sensitivity in mind, we can react quickly to potential changes, due to a change in macro environment, or one day when we wake up, we find that the currency actually dropped by 10%, or certain commodity price has gone up by 10%. We know exactly which company will be affected and how much of their earnings or ROE will be affected, and then we can react accordingly. And these some of the active ways, proactive ways that we have adopted in order to mitigate risk within the small cap universe. But of course, for our funds, we also have some soft cap that enable us to stop us from having too much risk in certain areas. For example, we try to limit our country over or underweight within plus or minus 5%. We try to limit our sector over and underweight to plus or minus 7%. Our single company weight will be limited to 3% most of the time. So these are the areas that we would do in order to, from a portfolio risk management perspective, we try to mitigate the risk involved.
Could you share with us what are the other risks to monitor, or what are the risks that you foresee, and how do you manage the downside risk of your portfolio?
In general, since we are turning more positive over the Asian economies, we don't see a lot of significant risk going forward. But of course, we need to monitor, the Fed's movement, U.S. situation, as far as the QE tapering is concerned. But at this stage, we think we don't see interest rate hike in the next 11 to 12 months. Yeah, and the QE tapering will happen. But the fact that if you look at the Asian markets valuation as compared to last two rounds of the ending of the QEs, Asian exJapan market is trading at much lower valuation compared to the past two rounds. And also going forward, as I mentioned, US the reason for the QE ending this time is pretty much because US economy is finally building on a strong foothold. Unlike last two times, people were worried that once the QE ended, what's next? The economy is not going to be supported. There's no more drivers. So I would say that this time around is quite a different situation. Although we still continue to monitor the potential risk as a result of QE tapering, we are not too worried about it. But there are obviously other unforeseen risks that we cannot anticipate. For example, what's happening in Iraq and US, what's happening in Ukraine. Although they may not have a big impact on Asian economies, we still need to monitor on that situation with Ebola. These are the things that we cannot monitor, cannot foresee. So these are the things that we need to continue to monitor.
Since we are on the topic of macro risk, we see mixed data coming from China, as a lot of reform initiatives are taking place since the third plenary in November last year. With China reforms deepening, leading to higher market volatility, how should investors position themselves in the greater China space?
Okay, I think there have been a lot of interest in SOE reforms. Yeah, we already see some reform happening in the energy sector, in the telecom sector. Yeah, and recently the Chinese government has also announced a list of SOEs that will fall under the pilot scheme of SOE reforms. Yeah, so I think things are definitely happening, and I think this is positive in the long run because first of all, these SOEs will start to invite private ownership, private investments in order to help them because SOEs is one of the major sectors in China, driving the economy, but they are not performing in a very efficient way. So private investment is good. On the other hand, the government will also open up some sectors that were previously restricted to SOEs only, so that also benefit private investment, and especially for other private entrepreneurs, who previously were not given any opportunity to invest in these restricted sector. So. And also bank lending, banks are getting more proactive towards lending to SMEs and also helping them to lower their funding cost, which is also positive. So all in all, I would say that things are turning for the better. As to how big the near-term impact is, I'm not sure. Maybe it's more like a medium to long-term impact. But overall, I think it is a positive move.
In particular, referring to the Shanghai-Hong Kong Mutual Stock Connect, also dubbed as the True Train scheme, what are the investment opportunities which investors can look into?
The Shanghai-Hong Kong Connect is very interesting. I think there are three major themes that investors are looking into. First of all, the discount or premium between the A shares in China and A shares in Hong Kong. So people like to, there's already a lot of arbitrage activities going on for those A shares which are trading at a steep discount to the A share counterparts. And I think after the the Shanghai Connect started, I think there were people who would like to buy into A shares that are trading at a discount to the exshare counterparts. And also the third theme is within the same sector, there are A share companies and H share companies, right? So people will also play on this kind of arbitrage for stocks within the same sector. So these are the three major themes that investors are interested in right now. But I would think that, you know, currently, I mean, if in the initial stage of the implementation, investors are only allowed to invest in a certain group of companies. So not everything within the universe. We expect that to be gradually relaxed. So even for a lot of the small cap companies that don't fall under the list of, you know, the stock list at the moment, I think they would also benefit eventually.
How would this initiative affect your investment philosophy or your portfolio construction?
Currently, there are over 7,000 stocks in the small cap universe. If you look at the A-share small caps, for those that are with market cap of $2 billion US or below, there are 2,000 over of them. So altogether, I think I've got 2,000 more stocks to look at, and more opportunities, of course.
Once again, thank you, Ms. Elina, for sharing your insights with us here today. For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.